Good morning, everybody. This is the live market open for March 15th. It's Fed Day and many other things. I'm Yohay, I'm Forex Crunch and Market Movers, doing the show as usual for FX to read. In today's show, as usual, we'll cover recent developments in markets, cover charts and levels, our technical segments, talking about majors and then crosses. Then we'll discuss the upcoming events. It's not only the Fed, there are more rate hikes and other stuff. We'll preview, of course, on the Fed. That's the main event for today. Our currency of the week is dollar CAD, and then we'll talk about the week ahead and wrap up the show. As always, your questions are more than welcome. If for any reason you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fx3-live-video. Okay, so thank you very much for coming. What's going on in markets? Well, the big event, I already talked about it. I mentioned it. It's the Fed decision. A Fed rate hike is coming. The big question is what's next. Okay, the Fed told us in more than thick hints that the rate hike is coming today. They're going to raise rates for the third time since the financial crisis. They telegraphed it very well. So there's a bit of tension, but markets are still on the move. The tension doesn't mean that markets are not moving. Last week, the ECB made a minor shift to the hawkish side, so that pushed the euro a bit higher, but we're still hesitating over there. It's not only because of the Fed, it's also because it's unclear how big that shift was. We'll talk about that a bit later. Dutch elections, let's a bit talk about that. Who will top the polls? That's the main question. So the Netherlands, it's a medium-sized country in the Eurozone, but still an important one. Not big like Germany, France, Spain, Italy, but many things that happen first in the Netherlands and then continue in other countries. So if you want, the Netherlands can be the canary in the coal mine in this case being France. So the elections today in the Netherlands for market serve as a precursor to the elections in France in April and May. Okay, the big question, the Dutch system is not, they don't have a president, they have elections for parliament, one constituency, very simple, very straightforward, very Dutch if you wish, and they always have coalition governments, okay? I don't think they ever had one party winning an absolute majority. They're always coalition governments. So the big question is, will the extreme party of Geert Wilders, the Freedom Party, will they come out as the first party in parliament? That does not mean they will form the government. Wilders will not become prime minister because all the other major parties said they will not cooperate with him. But if his party, which is anti-Islam, anti-Euro, they talk about an exit, a Netherlands exit from the Eurozone. If they come out in first place, it could, first of all, show that these ideas have a strong following in Europe. And that tells us something about other countries, and it could also influence the elections in France, for example, okay? So it could give a boost to Marine Le Pen in France. The other main candidate is Mark Rutte, the current prime minister. He's leading the Liberal Party. His party is set to lose seats in parliament, but still come out on top. If he comes out on top, that will send the message that, okay, the mainstream parties are still in control. There is lower risk of Le Pen winning the presidency in France, and it'll be a bit calmer for markets. Usually, I never talked about the Dutch elections. I think not many others follow it that closely. I mean, of course, it's important for the citizens of the Netherlands, but no, the Netherlands forms part of a larger Eurozone, and there are more important, well, bigger countries, maybe not more important, but but this one is watched very, very closely. If you're going to trade this, remember that the exit polls, voting ends at 8 p.m. GMT. That's after the Fed, 9 p.m. Amsterdam time, 9 p.m. here in Barcelona time. That's when we'll get exit polls, but then the full results will come later on. The Netherlands are going to vote, they're going to count votes manually because of fears of Russian hacking. So that's an event. Let's continue. So let's get back to we talked about the Dutch elections. The French elections, Marine Le Pen still leads the first round, okay? According to polls, there are many opinion polls. I follow the one released by Opinionway every day at 11 a.m. GMT. Francois Fillon is embroiled in a scandal, and Emmanuel Macron is said to come second in the first round, and then in the second round he is expected to beat Marine Le Pen. So there haven't been big changes over there. Brexit has passed all the legal hurdles. That means that it passed the House of Commons, House of Lords, House of Commons once again, House of Lords once again. Now, Theresa May, the UK Prime Minister, has all the legal power to trigger Brexit. It's expected to come at the last week of March. That's what she told us, from the outset back in October or something like that. And more importantly, more symbolically, the exit will come after the party, after mentioning the 60-year anniversary for the European Union on March 25th. So I think they want to do it a bit separately. Now there's talk that Brexit negotiations will begin only in June. So I guess the European Union has an interest to drag it because the European Union is the bigger party to this to these negotiations, and they have more power. Oil prices plunged. The next thing, it happened just after the show last week. It happened on Wednesday, and they continue. Oil prices are still depressed, are still to the downside. Okay, so that's that hurts, of course, the Canadian dollar. We have our special segment about the loonie later on. So that's what's going on in markets. Let's continue with a bit of data. Okay, so ahead of the Fed, we had the non-farm payrolls. Basically, what you need to know for the Fed is that the non-farm payrolls cemented. Okay, the Fed hiked today. No need to overthink it. But the figures are still important for the longer run. 235,000 jobs gained with very minor revisions. So a great report on the job front. Wages 2.8% year over year. Also great. Also moving, accelerating, showing that there's more upside pressure. That means that when employers have a harder time finding employees, they raise salaries to lure them. Okay, so that's a positive sign. What happened in markets is that wages month over month were only 0.2% up to the upside instead of 0.3 expected, but there was an upwards revision. Okay, so markets or algorithms saw only that, and maybe it was the sell the fact number. Anyway, all the report, as I've seen it, was looking good. Participation rate is up to 63%. U6, what's called the real unemployment rate, dropped to 9.2. The employment to population ratio is up to 60%. So it's all good from that report. We'll mention this also in our Fed preview. The European Central Bank, minor hawkish tilt. Well, at first it seemed like a very boring non-event. I hope you all followed Gloria Bednarik and I and Mauricio Carrillo in the Fed in the ECB coverage last week. Anyway, but then they said they removed the clause saying we'll use all instruments. And Draghi explained that. He clarified that there is no longer a sense of urgency. That was seen as a hawkish tilt and euro-dollar advance. Okay, then on Friday, we heard a report that the ECB could hike rates before ending QE, but there was no confirmation, even a denial. It didn't seem very serious. So I see euro-dollar stuck in range. We'll look at the charts quite soon, and we'll see that we haven't seen any big shift. Okay. The other data, ADP and non-farm payrolls was also excellent. In the United States, 298,000, so the US jobs market looks good. US PPI released yesterday was positive, stronger inflation, the two mandates of the Fed. Crude inventories jumped 8.2 million. That's what triggered the sell-off, but it wasn't the only reason for the sell-off in oil prices. Figures from China, inflation and trade balance were a bit skewed by the new year. Industrial output was a bit more solid, 6.3%. Did not move markets too much. Industrial output dropped by 0.9%, and for our Canadian segment later on, we had a great Canadian jobs report, 15,000 jobs gained, and the unemployment rate dropped to 6.6%. Okay, so that's our introductory part about the news. Now we'll cover the charts. So this is our technical segment for major pairs on March 15th, the Ides of March. Let's move to euro dollar. Okay. So this is the daily chart. As you can see here, we are at 106.33 on euro dollar. Basically, if we look at the bigger picture, the daily chart, we're bang in the middle of the range. Let's zoom in just a bit more to the hourly chart. So there's weak support here at 106.30, more or less. Okay, stronger support at 105.90, and much stronger support at 105. Okay, we reached that level 2 weeks ago. To the top side, we have 106.80, and more importantly, 107.10, a veteran line that continues being relevant for euro dollar. Pound dollar suffered quite a downfall. We covered that in depth last week. Currently, we're seeing a rise, which I cannot explain. Seems like a fat finger or profit taking after the big falls. In any case, pound dollar is trading very nicely in range. Okay, so I think we can already mark here a double top on pound dollar, 122.50. Quite an old line. Well, mentioned it during several shows. To the downside, we have 121.20. This line was temporarily breached, but we didn't cross it, so it's a very, very nice 130 pip range for pound dollar. Looking up, we have 123.50, 124.15 to the upside, and to the downside, under 121.20, we have 120, a very round number. Maybe it'll fall once May triggers Brexit. Dollar yen perhaps best reflects movements in the dollar. That means will be best suited to follow the Fed tonight. 114 serves as weak support, followed by 113 and 112.50, which is already much stronger support. Resistance at 115.50. But as you can see, dollar yen reflects the tension towards the Fed. The ranges here are becoming narrower. Okay, so we can see this wedge forming, and it is set to explode. To which direction, we still do not know. Dollar CAD, of course, dollar CAD moved to the upside on oil prices. Quite a big leap over there. It's currently hugging the pivotal line there of 134.60, a very old line. Resistance at 135.40. Okay, following that, we have 136. To the downside, we have 133.80, also quite an old line. So I would say the current range is 133.80 to 135.40. Okay. Aussie dollar. Well, it's one notch lower. It used to trade very nicely in range between 76.10 to 77. Currently, it's lower between 76.10 and 75. Okay, it's currently a bit higher within this range, but quite limited over there. Kiwi dollar is recovering. It fell to support, almost to support there at 68.80. So this still continues serving as support, further support at 68.20. Milk prices dropped, didn't look so good. The RBNZ was dovish. Anyway, for technical line, 68.80, 68.20, and to the top side, 69.50 and 70.50. The round number of 70 does not have any technical significance at the moment. And dollar Swiss ahead of the Swiss rate decision, currently 100.75. All right, strong resistance here at 101.70, and support is at the line of parity. Further below 99.60, and to the upside we have 103.30, which is far, far above. Okay. So this concludes our technical segment for majors on March 15th, the Ides of March. And now let's discuss the crosses, technical segment, support and resistance line for crosses on March 15th, the Ides of March, as known in Roman times. We'll begin from Euro Swiss, which probably has undergone intervention by the Swiss National Bank. Look at this spike. This does not look that natural, and we know that they openly intervene. It's no secret. 107.15 is the current level. 107.50 is resistance, and much stronger resistance over there at 108.30. Okay, to the downside we have 106.80 and 106.25. Okay, so that's the current range for dollar Swiss. We can expect big movements tomorrow morning for Euro Swiss. Okay, Euro Pound. Okay, we've seen this weird move to the top upside on the pound, and we can see it also in Euro Pound at the moment. So strong resistance there at 87.88. Okay, 87.90. This line in the middle, 87.80, used to be support. Now it's resistance. It's followed closely by 86.60. Okay, further below we have 85.75. So all in all, the trend is to the upside here on Euro Pound. A weaker pound in recent weeks, and the euro has been relatively stable, even moving higher against the dollar. But now we've reached this double top here at 87.90. Continuing to euro yen, 121.90 is the current level. 122.90 is the resistance, followed by 123.30 and 123.80. Okay, these were recent lines of resistance. Support there at 121.30 and 120. This round number does serve as support. Further below, I would mention 118.15. And the dragon, pound yen. Surprisingly, the dragon is relaxed. So we are seeing here some range trading, more limited moves here. 140.50 caps the pair, caps this cross at the moment. And to the downside, we have 138.60. Further below, 136.40 is a strong line of support. To the top side, 142 and 142.80, immediate levels of resistance. And 144.80 is already very strong resistance, a bit further above. Okay, we'll conclude our crosses segment with moving to oil prices. Look at this big fall. Long period of trading in high ranges, and boom, we fell to the downside, 48.50 at the moment. Okay, we reached a low there of 47, which serves as support. Resistance 49.50, not as strong as it used to be. And further above, we have 52, which kept the pair for a long time, 54.50, and then 55.20. Okay, that's crude oil. We'll talk about that as aforementioned in the dollar CAD segment. Before we move on, I see here comments. Ed, good morning, Ed. Fed may raise rates, but if it indicates less hikes, that will kill the dollar. I agree. I certainly agree. And we'll talk about that very soon. And the rally in the euro, yeah, not only the euro, I would say also in other. If they go to the other side, not sure I understand the second comment, but yeah, if the big question for the Fed is how many hikes will they signal in the near future in 2017, right? And now we'll continue to the upcoming events, not only the Fed. So let's take a look. Quite a long day today. We have the Dutch elections. Voting is open in the Netherlands. Around 13 million people have the right to vote. And what we need to know is that polls close at 8 p.m. GMT. That's just after Yellen concludes her press conference, and that's just when US markets close. Now, if the elections are quite close, we won't have a clear picture of who came first, Wilders or Rutte. Wilders extreme right, Rutte center right, until early in the morning, okay? But we'll here talk about the Dutch elections throughout the day. Just after today's show, we have at 9:30 GMT the UK jobs report. Let's see if Brexit begins hurting if wages fall, real wages, because of the weaker pound, because of rising inflation. And jobless claims, of course, are important because they show if there is a change of trend. We have two key top-tier releases in the US, but they will probably be ignored because of the Fed. That's retail sales and CPI. Retail sales, the US economy is all about consumption, almost all about consumption, and inflation figures, which of course the Fed probably already has in its meeting. At 6 GMT, it's a bit earlier because in the US they already changed the clocks. At 6 GMT we have the Fed decision, and with the dot plot and everything, and Yelen's press conference begins at 6:30 GMT. This is an opportunity to invite you all to the live coverage of the show. After that, we have GDP in New Zealand at 9:45. So if you're trading the Kiwi, it's also a top tier release. There's only one and final GDP release in New Zealand, so no revisions there, okay? And if we continue with top tier figures also on Thursday, this begins actually only a few hours after the Fed. At half past midnight GMT, we have the Australian jobs report. No big change, well, more of the same as expected, about 15,000 jobs gained, and the same unemployment rate of about 5.7, if I'm not mistaken. During the night, during the Asian session, we have the Bank of Japan, which is not expected to raise rates. Well, sorry, not expected to do anything. Then they meet 14 times a year, and this is not one of their more important meetings, but they have a chance to react to the Fed. So let's see if they're more upbeat on beating deflation in Japan, or not so much. At 8:30 GMT in the morning, we have the Swiss National Bank's decision. They have a very negative interest rate of minus 0.75. Okay, no changes expected, and they have a policy of intervening in currency markets to weaken the franc. Also, there are no changes expected, but we've seen some jitters in markets. We've seen the Swiss franc weaken towards the release. Maybe some are expecting, or maybe they are moving towards any kind of change in policy. So I would keep an eye on that. Just a reminder, about 2 years ago, the Swiss National Bank abandoned their peg, the Euro Swiss franc floor of 120. The cross collapsed, the Euro collapsed, and quite a few Forex brokers collapsed as well. So you can they can surprise us, okay? Final inflation figures from here, from the Eurozone at 10 GMT tomorrow. And then the fourth rate decision, it comes from the Bank of England. Mark Carney and his colleagues do not have the quarterly inflation report, but they have an opportunity to react to the weaker pound. So no changes expected in interest rates, no change to the QE program, but they might warn that the weaker pound pushes inflation higher and makes things complicated for the UK economy. So I'll be watching for that. They have a short statement, but very long meeting minutes. So the focus is on the meeting minutes. This week, we also learned that nominee for deputy governor, Charlotte Hogg, was forced to resign after she didn't fully disclose that her brother worked in Barclays. I'm not familiar with all the details of the story, but she was seen as a heir to Mark Carney in the future. So it's a bit of internal politics at the Bank of England. It should not impact the pound in tomorrow's decision. And it's a Fed hangover day, but we still have some US figures tomorrow. 12:30 GMT, housing starts, building permits, Philly Fed, and jobless claims. And at 3 GMT, it should be 2, pardon, it's a mistake here. It's the jobs report, also jobs figure. Anyway, I think US figures will be ignored because will be further reactions to the Fed tomorrow. And on Friday is some time to breathe after the Fed. Canadian manufacturing sales at 12:30, industrial output from the United States, and consumer sentiment, perhaps the most important figure from the United States. Well, for markets on Friday, the preliminary release of the University of Michigan Reuters consumer sentiment, but I think we'll still have Fed reverberations. Okay, so that's our upcoming events. Quite busy, I would say. I believe we have an event for every currency. if it's the Australian jobs report, the Kiwi GDP, rate decisions in the UK, Switzerland, Japan, and of course the United States of America. Okay. And now, finally, the Fed preview. We mentioned the Fed so many times. We mentioned the hike. Here's Janet Yellen hiking. Okay, that's not a real picture, but and Janet Yellen on a US dollar bill. So that's the big event we have been waiting for. Again, markets did move quite a bit. It's not that tension held things back, maybe only in dollar yen. So let's talk about the Fed, a hike, and what's next. A bit of background, wait and see approach. So we had a hawkish hike in December. The Fed upgraded its dot plot from 2 hikes in 2017 to 3 hikes, but markets saw only 2 hikes. Then we had a disappointing wage growth report in January, and we learned that Fed officials actually believed Trump. Actually, they priced in a fiscal stimulus into their projections, and we learned that well, Trump is moving slowly on infrastructure and taxes. In any case, there was some well, disillusionment, some expectation that the Fed will only raise rates in June. But then things changed quite rapidly. So 2 weeks ago, we had a coordinated attack, a chorus, if you wish. Doves and Hawks all talked about a compelling case for raising rates. Rates are too low. Relatively soon is relatively soon. Very strong words. And even Yellen said they will basically raise rates, barring any disaster. The non-farm payrolls was good enough. No disaster. It's very rare to see the Fed talking in one voice. Usually they're all over the place. Doves are dovish, hawks are hawkish. And this one, in this case, they not only talked in one voice, but this voice was a hawkish one. Remember, Fed officials, Yellen and beforehand Bernanke, they usually see the dovish side. They're usually very cautious. Okay, so that was a very, very clear message. So I would say I'm going to present soon 3 scenarios for the Fed. All of them include a rate hike today. There's no chance of a no hike. Okay, the big question for the Fed, big question for the US dollar is the dot plot. Okay, this weird chart shows how many rate hikes are forecast for the next years. 2017, 2018, 2019, it's what's on the agenda. Most importantly, how many hikes will we see in 2017? It currently stands at 3 hikes. That means 1 today and 2 more, maybe in September and December, maybe in June and December. It doesn't really matter at this point. What matters is, will they change the dot plot? And that's the most important event today. We also have the statement, of course, like in every meeting. And we also have forecasts for growth, inflation, and employment, as well as the press conference by Janet Yellen 30 minutes after the event. Another opportunity to invite you all to the live coverage of the event with Valeria Bednarik, Mauricio Carrillo, and myself. So what will determine the Fed's dot plot? What will determine their general tone, more hawkish or more dovish? The Fed always tells us they're data dependent, and the Federal Reserve has 2 mandates, jobs and inflation. So if we look at the Fed mandates, it's a rosy picture. Jobs continue growing nicely, 200,000 or more, around these figures every month. That's solid job growth. Inflation looks stable. 1.7% is the Fed's favorite number, the core PC price index, about double the core inflation in Europe, very close to the 2% target, and rate hikes haven't pushed it down so far. The Fed wants to be ahead of the curve to keep inflation controlled before it gets out of control, okay? And other inflation figures like core CPI and various other measures, they look healthy as well, okay? Not overheating, not and not in deflation territory. So it's a good time to raise rates. However, looking forward to the future, what the job growth and wage growth and inflation gains are a result of growth. There is a lag, and growth looks a bit worrying. So we had strong growth only in the 3rd quarter of 2016. If we look at recent history, 3.5% annualized, but it was around 1.5% in Q1 and Q2 last year, And in Q4, it was only 1.9, okay? It wasn't a tale of two halves. It was a tale of one strong quarter and three weak ones. If we look at the initial figures for Q1 2017 for this year, we're already 2.5 months into the quarter. We have some figures: retail sales, durable goods orders, other stuff, and we have estimates. So if we look at the Atlanta Fed estimate, the nowcast, it's only 1.3%. Okay, so current growth estimates for Q1 look very weak, very poor, and Trump, which was expected to boost the economy with infrastructure spending and tax cuts, he's focused currently on healthcare, Trump care. Okay, so of course the Fed is in a wait and see approach with the Trump, not so optimistic. So these policies are not pro-growth. So without growth, employment is set to slow down. Okay, so if the Fed looks forward, looks into growth figures and projects them on employment figures in the future, it doesn't look that rosy. So let's talk about the scenarios. My baseline scenario, is what I call a healthy hike. Okay, that means no change to the dot plot. That means the Fed raises rates now because it told us so. It leaves the forecast for 3 hikes, and it tells us it's in a wait and see mode. It means it's data dependent, as they always say, moving along as the economy moves forward. Markets could doubt that there will indeed be a 3rd hike. Maybe they'll begin pricing in, once again, like in December, only 2 hikes. And even if they don't doubt that, we could see a moderate sell the fact response, okay, like we've seen to the NFP, okay? And then perhaps a second wave of selling. Now, in this scenario, it's not such a big change, but we could still see a sell the fact and perhaps, of the dollar, and we could see a moderate fall in the US dollar, nothing too big, okay? They could also be a bit more optimistic without changing the dot plot, and in this case, the dollar would remain stable. This is the baseline scenario, which is in line with what markets are expecting, okay? Now let's move on to the other scenarios, okay? If you probably heard this phrase, if you're tuned into financial analysis, a dovish hike. Can a hike be dovish? I mean, how can you raise rates and be pessimistic, be dovish? Well, one excuse is that the Fed is raising rates in order to be able to lower them if things get worse later on. I don't really buy that argument. Why would you do that? Why would you cause financial distress so you'll have the tools to battle this financial distress? I don't get it. But there's another theory that says stock markets are looking good now. The Fed works for Wall Street, if you wish. It's a good time. They're taking an opportunistic approach, raising rates now, because later they cannot do that, okay? Because later stock markets could be more in a turmoil, okay? So they'll hike now on good financials and then wait for a long time. In this scenario, they will stress that there's, high uncertainty ahead. They'll downgrade the dot plot to 2 hikes this year, or even if they don't downgrade that, they'll be very, very dovish. They'll be very worried, say, okay, we raised rates, but we're going to take a big, big pause. And this could trigger a big dollar sell-off. It could trigger an immediate fall of the US dollar tonight, and then follow-ups in the Asian session and in the European session tomorrow morning. This has lower probability, but I wouldn't rule that out because the Fed is naturally dovish, okay? And I don't think that their talk with one voice about hawkish, in a hawkish tone about raising rates, I don't think it's the new normal. I think it's the exception, not the norm. So I would give this scenario a sort of medium chance, for a dovish hike for a dollar sell-off. And scenario number 3, which I see as having very low probability, is a hawkish hike. That means Yellen expresses high confidence. They even hike the dot plot to 4 hikes this year. That means now in March, then in every big meeting, that means June, September, and December. That means they're very optimistic about the US economy. They're foreseeing strong growth ahead. The dollar rallies hard in the immediate reaction and continues higher. Again, I I see a low probability for that. The Fed is naturally dovish, but we have to get ready also for this scenario. So to conclude our Fed forecast, Fed preview, it's going to be a rate hike that appears in all my scenarios. The dot plot determines the immediate reaction, okay? So the number of hikes for 2017 is the immediate reaction, but it's also important to see not only the dot plot in case it remains on 3 hikes, but also the general tone of the statement, tone in the press conference, and other forecasts. The baseline scenario is for a healthy hike, probably keeping things balanced, and then a moderate sell the fact scenario could be seen, a weaker US dollar, but it also depends on the tone. Other scenarios are more extreme, a dovish hike that would trigger a big sell-off, and a hawkish hike that would trigger a huge rally in the US dollar. Okay, so that's our Fed preview. Any questions? So let's continue. Our currency of the week is dollar CAD. For many of you, it's been a bit in the background, but I want to talk about that because of the crash in oil prices. So first of all, let's explain the crash. It was triggered by the inventory report 1 week ago that showed a rise in inventories, but it showed a rise in crude inventories and it showed a drop in gasoline and distillates. So for me, it was only the match that started the fire. The bigger background is the OPEC deal, okay? So back in November, OPEC and non-OPEC members surprised the world by reaching a deal on cutting production. So if we focus on OPEC, they're 90% compliant. 90% sounds great, and in the past they had a much lower compliance rate with cuts, okay? On the other hand, it's mostly Saudi Arabia that cut production, and they cut production even more than they were expected. Other countries are actually not that compliant. Moving to non-OPEC countries, it's Russia, mostly Russia, okay? And they're going very slowly. They have not met their obligations, and for all non-OPEC countries, it's about 60% compliance, okay? And there's uncertainty about the deal extension. Remember, this deal is only for 6 months. It's only for the first half of 2017. There's another OPEC meeting in June. And all we're hearing so far is that they're not sure if they're going to extend the deal. And of course, it was always the big elephant in the room, or not elephant, US shale production. So when prices rise, US production rises. When prices fall, US production falls. So as prices were holding high ground for some time, production from the US increased. So we crossed the 9 million barrels per day level, and production is on the rise. And the inventories only provided the spark. So here's the WTI crude oil chart. As you can see, from early December until early March, prices were high, but we saw a rejection there, the double top of 55.20, and then we crashed lower, and currently we're in a much lower range. So, but Canada also looks good. Here's Prime Minister Justin Trudeau meeting President Trump in one of the more successful meetings that Trump had, and I think it was successful also for Canada. So there's no risk from NAFTA changes, no risk. Well, the US is more focused on making a better deal with Mexico, but not so with Canada. There were 3 consecutive wins for jobs reports, okay? So 3 huge surprises. The unemployment rate fell in Canada to 6.6%. Job gains are looking good. More in particular, job gains were concentrated in full-time jobs, not part-time jobs. And Canada, of course, is not only about oil. But at least in the short term, oil prices are still set to weigh. The Bank of Canada was recently a bit dovish, a bit sort of, I would say, more cautious than dovish. And eventually, a weak Canadian dollar helps the economy. So we have a weak Canadian dollar. It helps the Canadian economy. And then the Canadian dollar rises. The Canadian dollar rises. It weighs in the Canadian economy. And we're in this pendulum swing. Okay. So what's next for the Canadian dollar? I would say that in the short term, falling oil prices, I'm not sure we've seen the end of the falls. They could have the upper hand, but I wouldn't say it would last that long. So It could be a short-term rise in dollar CAD, and then we could move higher. So let's take a look at the Canadian dollar to conclude this segment. Currently 134.50. Let's zoom out. We can see that we're at the higher end of the wider range. Okay, so and to the top side we have 135.40, 136, and 136.35. Sorry, 136.40. If we move even higher, the next significant lines of resistance are only at around 140. To the downside, we have 133.80, 133, 131.80, and 130 as a line of support, much lower support at 127.70. Okay. So this concludes our dollar CAD segment. And now let's preview the week of March 20th to March 24th. It's a Fed hangover week. I think the Fed will have an impact also through next week, especially on Monday when there's nothing much on the calendar. On Tuesday, we have the RBA meeting minutes. They were extremely neutral, and we could perhaps learn a bit more because we didn't learn too much from the recent meeting from the Reserve Bank of Australia. We have the UK inflation report. This is a big event for the UK. Brexit resulted in a weaker pound, resulting in higher inflation, causing a stagflation problem for the Bank of England. So let's see if this problem worsens. In Canada, we just talked about, we have retail sales. We'll have more action from Canada. This certainly moves the Canadian dollar. This report for those trading the Kiwi after this week's GDP report, we're back to our usual routine of milk prices every other week. On Wednesday, we have oil inventories. So more stuff for C dollar traders, and the rate decision in New Zealand. No changes expected. They're expected to leave chain rates unchanged, and perhaps continue pushing for a weaker Kiwi. On Thursday, UK retail sales, they've been quite bad recently. Also a result of the weaker pound. Brits are buying more essentials, less non-essentials. Let's see if this continues. Jobless claims in the US, like every week, new home sales, and New Zealand trade balance. And on Friday, we have Eurozone flash PMIs, durable goods orders in the United States. This is a good measure of investment, which is a good measure of growth. So if we mentioned growth as an issue for the Fed looking forward, this will provide more data about that, and the Canadian CPI. So we have lots of figures for those trading the Canadian dollar, our currency of the week. Okay. So it's time to wrap up the show. This is the wrap up for the live market open for March 15th. The Ides of March, as Roman said. We covered lots of stuff. Basically, all the eyes, well, most eyes in markets are looking at the Fed. A Fed hike is coming. The big question is, what's next? Will they keep it a healthy hike? My baseline scenario, leave the dot plot unchanged, being data dependent, raising rates, and thinking what's next. In this case, we could see a mild dollar sell-off on the fact, nothing very big. It could be a dovish hike, sort of one and done for a long time, and then the dollar would fall, or a hawkish hike, which means they'll raise the dot plot to 4 hikes in 2017. In this case, the dollar will rally. The euro got a boost from a minor hawkish tilt from the ECB that sees less urgency. The Dutch elections, the big question for today, it's held today, who will top the polls? If it's current Prime Minister Mark Rutte, it's Euro positive. If it's extreme right candidate Geert Wilders, it's negative for the euro. Okay, this has an impact, of course, on the French elections, where Marine Le Pen still leads the first round, but is set to be defeated in the second round. And Brexit probably triggered at the end of the month, but certainly moving the pound. High volatility over there. We'll look at the charts very soon. And oil prices plunged. This hurt the the Canadian dollar, also a big theme in markets for our wrap-up. Okay, let's look at charts. Euro dollar is very stable in range, waiting for the Fed, I would say, a bit, well, moving to the upside now. Levels to watch: 106.80, 107.10, to the downside 105.90 and 105. Pound dollar moving to the upside, creating a doubled up here at 122.50. Next resistance 123.50, support 121.20 and 120. Dollar yen. Here we can see the tension towards the Fed. 114 to 115.50 is the current range. I'm sure we'll see it exploding afterwards. Dollar CAD. Well, the Canadian dollar a bit recovering from the falling oil prices. Support 133.80 and 133, resistance 135.40. Aussie dollar one range lower, 75.85, resistance 76.10, support 75. And the Kiwi dollar support 68.80 and resistance 69.50. Currently we're higher in the range, also seeing some kind of a recovery right here. Okay, so that's the wrap up for today. Thank you very much, everybody, for coming. I wish to invite you to our live coverage of the Fed meeting. It begins half an hour before the event. That means that will be 5:30 GMT. Okay, that's 6:30 here in Europe, in the old continent, and it'll certainly be an exciting event for markets, for the US dollar. The big question is what's next, always looking to the future. So thank you very much, everybody, for coming. Wish everybody a safe and successful day in markets, and I hope to see you all later on in the Fed coverage. So that's it for today. Thank you, and bye-bye.